Joining me today is well-known certified financial planner Gajendra Kothari, and we are going to talk about financial planning. Thanks very much, Gajendra, and it's a pleasure to speak to you always.
Same here.
So my first question for you is, what is the starting point for financial planning? We tell people it's very important, and I think today's millennials are very open to the idea of saying that, look, we need to understand our money better compared to the previous generation. But I think they get stuck that where do I start? What is the starting point?
Right.
So can you tell us that?
Very simple, Vivek. There are 3-4 steps. The starting point, I always believe, is knowing yourself first. What kind of person you are, what are your aspirations or goals. So the first exercise is goal setting. List down your financial goals with the time frame. And then once you've done that, then you have to assess your risk profile. Whether you're a conservative person or an aggressive person or moderate person. You have to sit with a financial advisor, or there are some online calculators to know your risk profile. The second, after you've done that, you have to then go what options are available. And there are plenty of options available in fixed income category, right from fixed deposits to government schemes. And then you move to slightly up the ladder where you take more risk. You can go for equities. Within equities, you have different vehicles. So then the idea is to choose the vehicle which fits your risk profile and your goal time horizon, and then choose them, do an asset allocation. And what is asset allocation is basically how much of your money go into different asset class based on your time frame and risk profile. Do that and keep monitoring it every 6 months or 1 year until you achieve your goal. So this is how one should plan the finances.
And how do, Gajendra, mutual funds help you in building your financial plan?
Vivek, mutual funds are, I think, one of the best ways to plan for any goals. Be it a one-day goal or be it like 50 years down the line. You have amazing variety of products. You can choose mutual funds. The beauty of investing through mutual funds is that, Vivek, these are very transparent vehicles. These are open-ended schemes, which means you can enter and exit any point of time. Very low cost. You can track your performance. If you're not happy, you can come out of it. You can do monthly investments through SIP mode there. So it gives you all kind of flexibilities. So if I have 5 goals, Vivek, some may be short-term goals, some may be medium-term, some may be long-term goals, I can use mutual fund route, and within mutual funds I can go through debt funds, which are for shorter term, a hybrid kind of funds which are for medium term, which has a mix of equity and debt. And if my goals are like 8-10 years beyond and I can take risk, then I can go for pure equity funds where I can expect to create wealth and beat inflation in the long term and use them and to achieve all of these goals. So I would feel that mutual funds are in fact one of the best vehicles when it comes to planning your finances.
So when you say goal-based investing, can you tell us a little more about that in terms of what is the manner in which I pick my scheme linking to which goal, and do I withdraw my money when I reach the goal? How does that work in financial planning?
Yes. So we really encourage all investors to go for pure goal-based investing, because unless you have a goal set for it, you don't know what kind of product you need to go for. So the moment you have decided that my goal is for my children's education 10 years down the line, and if your risk permits, you can go for a pure equity fund where you can expect 10 to 12% return, which hopefully beats inflation. Once you've chosen the fund, you would keep putting money either through SIP or lump sum as per that determined amount. Once you've done that, you will just remain invested until you have achieved that goal. Now, 2 things can happen, Vivek. Either you may achieve the goal much before your time horizon, in which case we recommend that you move out from a risky fund, or you switch from a risky fund to a safer fund like a debt fund or a liquid fund, and wait till the goal completion date comes. So that is actually a better way. Or you may or if your goal has changed by then, if your amount has increased, or in fact I would rather say if there is a shortfall in the goal, then you have no choice but to top it up. In fact 3-4 years before the goal completion. Now let's say if you are in line with the goal completion, then also, Vivek, we don't wait till the last of the goal. We actually move out 1 year or 18 months in advance from equity funds, start gliding towards debt fund. Because what if there is a 2008 kind of scenario and your portfolio goes down by 50% and you have to pay fees on that day? We can't say that markets are down and sorry, we have to postpone your goal. And when we meet our investors 6 monthly, we discuss and we see what is the best course of action at this point of time.
What is the role of debt mutual funds in a financial plan? Because the larger part of the discourse always is around equity, and people think that mutual fund means equity. But debt too, I'm presuming, has a significant role in a financial plan. And you talked about the asset allocation piece. So what is the role of debt mutual funds? And can you tell us a little about the kind of schemes that exist there?
Yeah, so debt mutual fund is a very lesser understood product within the mutual funds. Within debt mutual funds, there are many categories of options you have. And as I told you earlier, you have option right from 1 day to maybe up to 10 years you can invest in a debt fund. Debt funds can invest in different categories of investments. Like you have a debt fund which invests in pure government securities. Many people think fixed income means fixed interest, which is not the case in debt funds. When you do a fixed deposit, you know on day one what is the interest you are going to earn. But within in debt funds, there is nothing called fixed interest, but you earn something called returns, which are a factor of two things, Vivek. One is the coupon which is earned when your fund manager has done the investments, and the second is market linked return based on the interest rate movements in the economy. Normally, Vivek, we tell that most of the investors who would like to come to debt funds are the investors who are not very happy with the fixed deposit returns, and they fall in highest tax bracket, so they're paying straight away 30% tax in FDs. In debt fund, you have this tax advantage wherein if you stay beyond 3 years, you fall into long-term capital gains, where you have to pay 20% capital gains tax with indexation benefit, which is not available in FDs. But if your goals lesser than 3 to 5 years, you should stay in debt funds only, Vivek. And this is how you can use debt funds for goal planning purpose. So I think it's very superior. It's a long answer, but
great talking to you as always, Gajendra. Thank you very much.
My pleasure.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.